Ulrich, you seem to have an idea about it. Where would I want the autocorrelation line to be if I'm going to trade the Fisher transform narrative? In other words, potentially a max sell signal or max buy signal. Now, just on this chart, high or low? Simple answer, high or low? You got 50-50 chance. Andy, why are you saying low? Give me an explanation. Yeah, because what's happening there is very, very simple. The lower it goes, the more chance we've got of that negative correlation, right? If we're very high, we end up in a situation, right? So Andy's obviously got a grasp of this about reversion, right? So the lower it goes, effectively what's happening is the Nash has changed. Does everybody understand? I suppose, Andy, do you understand the relationship of that to the Nash equilibrium? It looks as if you do, right? So if I'm looking at the Nash equilibrium as a kind of game theory kind of concept, and you know, and I've often thought about how this would be taught, and it's very difficult without getting into the math behind it, but it's, you know, we're trying to obviously get it conceptually to a point where at least everybody understands. You know, if we've got a Nash equilibrium here, and you know, then of course we've also got this idea that that's the predicted next candle, right? And if that's the predicted next candle, the cycle that we're looking at is going to be a very, very, you know, a high level cycle. So in other words, the lag on this cycle is going to be quite substantial if you're looking at it from that point of view. Because obviously we're in a buy trend, right? So there's obviously this relationship that if we're in a buy trend, then of course the cycle that we're looking at is going to be quite a sizable cycle. Would you agree? I mean, it's just, it's, if that's what the cycle is versus a cycle that looks like this, then of course, if this is the same chart and the same resolution of chart, then of course what we've got here is we've got a very, very big buy side cycle, suggesting that Nash is likely to carry on a lot longer than the normal cycle. Do you agree with that? Is that reasonable? So what we actually can end up doing, and this is the problem with, this is going to be the problem you've got with any Fisher, with any stochastic, with any analysis of any sort like this, is that, you know, this cycle is maybe going to be, you know, a 100-bar cycle, right? Maybe it's going to be a 100-bar cycle, and then this cycle might be a 10-bar cycle. Now, obviously, if I'm using an indicator, this is maybe the better way of discussing it. If I'm using an indicator that has a cycle of 10, so a look back, right? Which of these two market conditions will throw really bad signals? Yeah, so this will throw really bad signals, won't it? And this will throw really good signals, won't it? Yeah, is that fair? Because obviously, if I then say, well, the indicator doesn't have a 100 candle look back, the indicator has a 10 candle look back, the indicator has a 100 candle look back. Which indicator is going to, which market condition is going to be better in terms of this indicator, in terms of this frequency? The first one, right? You know, because this is going to see absolutely nothing. because there isn't anything in this one to be seen. You understand? So if I look at this as an autocorrelation, and an autocorrelation of +1 means what? If I have an autocorrelation of +1, and my candle low was 25 and my candle high was 35, what's the forecast on this? Well, my forecast is that the next candle high will be 45. If the low price was 25 and high price was 35, according to Nash, the next candle high is going to be 45. 25, 35, 45. Yeah. If I've got an autocorrelation of -1, taking it as a very, very simple, if I've got a low price of 25 and a high price of 35, then my forecast low for the next candle is going to be 25, right? So you get that idea of this mean reversion that Andy mentioned from an earlier conversation, right? So obviously, when we're looking at something like Fourier transform, right? So Fourier is one of those elements, because obviously when you look at an autocorrelation, it brings in a discrete Fourier transformation into the mathematics behind it. So they do have an element of, but it is a vague element of understanding between the two pieces. But the key idea, of course, is that we need to know whether the market has this very high level of this correlation component or not. So basically, and it's been used, the kind of explanation of it before is very, very straightforward. If it's raining today, what's the probability of it raining tomorrow? Well, it's slightly higher than the probability of it raining today, because these things are a probability distribution. The weather gets slowly worse and then gets really worse and then gets slowly better, then gets a lot better. So things don't go from one to the other. Sometimes they do, but in most cases, they don't quite go from one condition to the other. So, of course, the idea of this is that when we see, this very low autocorrelation kicking in, we know that what Andy said is that if we get that very low autocorrelation kicking in, then the Fisher, for example, or even your RSIs or your STOs or anything else, becomes more probable in terms of a prediction than not. So when we see it's very, very high, we don't want to just jump in. As a good example, right? We don't want to just jump into the trade. Does that make any sense to anybody? So this is what we're going to start building through into the max. Would that make sense if Andy knows about this? Because ultimately the idea is that the process will then bring the idea of how long do we let this run into a pin zone, and how long do we not let it run into a pin zone. So in other words, when we look at a marketplace, the idea is that we should be able to let it ride as much as we possibly can do, and make a decision based on the fact that we're now reaching that point where that autocorrelation has been effectively fixed. And if we haven't seen it being effectively fixed, we need to wait for it to be fixed. So a good example is this pin zone here. Take a look at this pin zone here. So one of the things that we're concerned about when we ride into a pin zone is very, very straightforward. How far is it going to go through this pin zone, right? See how far it goes through the pin zone? So what we're trying to do is we're trying to come up with an idea of, well, how far is it likely to go through the pin zone? Because we could step in at this price here and try and buy it, and of course we would have lost money. And then we could step in here and we could try and buy it on the first A10 on the way down, of course, and we could have lost some money. And then we could have bought it on the second A10, and this time we finally get the A10 right. Or we could have waited until the price turns and then try and join in with the party afterwards. So the problem we've got is when we're looking at this is going to be based on a fixed cycle. It's going to be based on a fixed cycle. So one of the things you can do with this is that we can actually take some knowledge from the autocorrelation function. What knowledge can I take? Well, according to Nash, this market's bearish. Would you agree with that? If we draw individual candles, this is going to be a very bearish market, which goes back to the Nash classroom. The Nash classroom we did many moons ago. So the idea is if we can recognize this in the Nash equilibrium, we know that the Nash equilibrium tells us not to buy this. But that's easier said than done. What we've got to have an ability to do is visualize that it's going to be a difficult buy trade. So if I was asking you whether this sell cycle was a big number or a small number, what would your answer be? Big number or small number? It's going to be a very big number, right? It's going to be a very big number. If I asked you about whether this cycle phase here was a big number or a small number, what would your answer be? It's going to be a relatively small number, right? So in condition A and condition B, which indicator would work best? In condition A, which indicator would work best? A trending indicator, right? Something like a moving average even would work best in condition A. In condition B, which indicator would work best? Well, a trending indicator is going to get chopped out a lot, right? So in other words, something like a stochastic or an RSI or any of those types of indicators would work best in this scenario here, wouldn't they? So this is what autocorrelation allows us to try and visualize, is that it tries to detect when the frequencies are changing, doesn't it? So when I'm looking at this phase here, I don't know if this is going to be a bottom edge. So what I can do is I can look at that phase and I can try and figure out what the answer is. So when we look at something like this here, you can see, do you see how this has got a very, very high number here? Very high number here. Well, that tells me that the Nash is very, very bearish, and therefore it'd be very difficult for me to just step into this as a fade trade. You see that? You see how that gap there, when it goes sell side below the bottom edge of this move here? See that? So this is telling me that there's a real problem with me being a buyer of a fade. So when I start seeing this, do you see what happens at the very bottom edge here? You see how the very bottom frequency goes red? Well, that's telling us that we're starting to get some counter frequencies. We're starting to get that -1, if you like, that Andy was talking about, that mean reversion frequency. So it doesn't just have, the thing is, when we've got this line on the chart here, see this black line and the blue line? That's based on one main cycle. This is highlighting how many of the main cycles are there and whether the dominant cycle is a big cycle. Would you agree with that, Andy? Ulrich? So this is the dominant cycle, which is this sell side cycle. So obviously, if that's what the sell side, if that's what the cycle is, I want to be very cautious about bidding this low price. So when we start recognizing into this, we can start recognizing that we're starting to see some of these counter-cyclical elements coming into the market, which ties in beautifully with this narrative here. Because down at this level, this is only at 7, right? So if your Fisher was based on a number of, say, 10 or 8s or 14s or whatever, well, 7's below that threshold, isn't it? So obviously, therefore, the turn-in Fisher is going to be accurate when this is dominating. Do you see that, and do you understand that, and do you agree with that? So in other words, do you see what happens during this market when it goes nowhere? You see what happens? Look at how low the cycle narrative is. Do you see how low it is? So obviously when it's that low, the market is going to be rotating round and round and round and round and round and round and round we go. Now, obviously, when the cycle changes out of that rotation, you'll start seeing the cycle shifting. You'll see this line driving higher, which means, of course, you've got to be aware of the fact. And remember, it's still taking lookbacks. It's still going to be telling us that the market has, found directionality, because obviously we didn't break that cycle until the very end of this cycle, right? So, I mean, at that stage, it was still telling us, but you can see the coloring's almost vanished from it during this phase here. You see how the coloring's almost vanished? What you want to find is you want to find the bright orange, you want to find the bright red, you want to even find the yellow. If it disappears into nothing here, that's telling us that we could be moving to a different cycle phase, which means that when you grab that last buy opportunity when the cycle is as low as this is a very high probability buy trade. Do you understand that? Very high probability buy trade there. And obviously, if I was to get a sell trade up here, I'd have to be very cautious about selling this too early. Do you agree? Well, that's a good decision, because take a look at what happened. We got the first A10 here when it was almost black at that stage. It's not even got a shade of red at that stage. And then, of course, what happens if I sold that A10 is that I would have lost money, because we only started to see the red reappearing at that stage there. And at that stage there, we're now top ticking the price, suggesting that we've got enough evidence of the counter-cyclical that we can actually take our shot now at that sell trade. Do you see what we're starting to note? So this is part and parcel. Now, this has got nothing to do with the cosine and sine concept that we were talking about. If you want to get into the cosine sine, you start bringing in things like Hilbert and the like. Does that make sense to anybody that understands the mathematics? So in a perfect cyclical world, you can always predict what's going to happen. That's the easy thing, right? So in a perfect cyclical world, for example, the market goes up to a perfect top and goes down to a perfect bottom and goes up to a perfect top. And if this was the market, then this would be the sine wave. Now, obviously, what we're trying to do as traders is we're trying to get to the point where we can predict this. Well, in a perfect sine wave world, well, it's dead easy. When as we reach this price here, we're going to buy it, and as we reach this price here, we're going to sell it, right? Now, Fisher doesn't do that. Fisher's about statistical distribution. It's not necessarily about frequency, and that's why we're adding to the Fisher. We're having to add the frequencies. Does everybody make sense of that? Does everybody understand that element? Because what Fisher tries to do is look at the individual frequencies and then apply a probability function to them. So in other words, it's like a moving, and we discussed this at the time when we did the classroom on it. It's like a moving volume profile or whatever. Is that reasonable? It's like a moving volume profile. It's not actually specifically about the frequency. It's about the volume profile in terms of distributions. So it's like a moving Z-score, if you like, which is why Reeve likes it so much, because effectively what Fisher does is become a moving Z-score. You may say, I don't understand this concept of Z-scores, because it all comes down to frequency distributions and the idea of random walk. Now, we can all agree that the markets are random walk, aren't they? Markets are random walk. So you might say, but then that means that there's no predictability. Yeah, any one trade is a random walk, right? It could be a buy trade coming in. It could be a sell trade to close coming in. It could be a sell trade to get short coming in. It's a random walk. So in the world of short-term trading, every single trade is random walk. It's pure chance, right? Flip a coin, it might be a buy. Flip a coin, it might be a sell. But inside the world of lots of random walks, then order appears, doesn't it? Do you agree? Order appears. Has anybody seen a Galton board? Has anybody got a Galton board? I was fascinated by Galton boards when I was younger. And the basic idea of a Galton board is the probability distribution. You've got this ball. You've probably seen it in the arcades. Remember, you put your coin in the top of a slot and it randomly goes down to some location. So if for example, if this was the board here, for example, if I put a coin into the slot up here, if I put a coin into the slot here, right, there would be a peg in the middle here. So there would be a 50-50 chance that it would fall to the right, 50-50 chance it would fall to the left, right? And then there would be two more pegs here. And then there would be three pegs, right? That's a Galton board. So what happens is there's a 50-50 chance that it'll fall to the right, 50-50 chance it'll fall to the left, and then it'll go into another 50-50 chance of the next board. So what happens is, of course, that in terms of a distribution, what happens? Well, we end up with a distribution that looks like, oopsies, that's not what it looks like. Well, we end up with a distribution, if this goes to the bottom edge, we end up with a distribution that will look like this, correct? So in other words, the chance that when we drop a coin into this board, that it goes to the left, and then 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 it goes to the left. Well, the chances of that getting to this point here are very, very slim indeed, depending upon how many pegs you're using. Very slim indeed. Because there's always going to be a next 50-50 chance every time we reach the next one. Now, we know in markets that that's never the case. And the reason for that is because there are black swan events that can create things called momentum, slippage. The market gets slippy. And therefore, skew becomes a massively important piece to this. And we can actually illustrate this quite nicely. There's a little thing called Maths is Fun. And I was looking for one of these to show you the basic idea. Maths is Fun. Okay, so this is what it looks like. Is everybody familiar with this board? We've just shown you it, right? So we've got a left-right skew of 50-50, right? So if I just press play, what will happen here is, so we've got 14 rows, okay? So we've obviously got 14 rows. We're now looking at this, and if I just 50-50, if I just press play now, you'll see what happens is that these balls randomly go 50-50 to one side or the other. And what will happen in due course is that, you know, we start seeing what is normally distributed in terms of this market, right? So you start seeing a normal distribution starting to function in terms of this narrative. And you can see at the far extremes, there hasn't been any recorded trades done at the far extremes. So this becomes what is a normal probability distribution, right? This is a normal, and I got one of these when I was a boy. I mean, my dad made me one when I was about 2 years old, and I absolutely loved it. It was my favorite toy of all time. And obviously, you know, what happens is that we start seeing that the more we do, the more chance of getting into those very, very far reaches. There's always a chance that one of them will fall into those. And, you know, and sometimes they can start out to the right, they can go right across to the left, and then they can drop down, or they can jump about, or, you know, but, you know, you can see that it forms that very simple, very obvious probability distribution, doesn't it? Now, the good thing about this is, you might be saying, I don't quite understand why we're even bothering watching this, because it's obviously just a normal probability distribution. We know this. Well, if I change this, and if I go back and I just stop this now that we've kind of shown this, and I look to restart it, right? But after I've restarted it, so obviously when we start doing that, we don't have a 50-50, do we? We don't have a 50-50 because The Fisher narrative tells us that we've already got a better than 50-50 chance, because that is a probability distribution done for us, effectively a moving Galton board on your charts. But obviously, one of the things that we also have is we also have relative value, where we start skewing the information, right? So for example, if I'm looking at oil and I'm starting to look at my oil narrative and I'm saying, right, I've got an idea that the oil price is probably going to go bid off the retest here, which is kind of what happened. So off the retest here, you can see that this is now very strongly bid. We're taking out the highs. Then, of course, we've now got a bullish skew in this. So obviously, we could argue that that bullish skew actually took this up to, say, 70-30, didn't it? It doesn't mean that we're not going to get sales, does it? It doesn't mean we're not going to get some of these distributions down here and you'll all be complaining, but my value was bullish. And what? It doesn't take away the probability that you might still get a sell, does it? So obviously, if I restart this now with a 70-30 bullish skew, we can obviously start watching this as a distribution as it unfolds. And because we've now got a slight lean on the board, which is effectively what we've added into this, is we've now added a slight lean on this. You can now recognize that there is now a very definite bullish skew to this. It doesn't mean there's still not going to be the odd occasion where we drop down into these low edges here. But you can see now that the skew is way offset 70-30. Well, this is what the delta buckets tells us, doesn't it? The delta buckets tells us this as a narrative. The delta buckets tells us that it's a 70-30, because that's what the implied volatility is, a probability of this being higher or lower than the other side. And therefore, the distribution doesn't mean it won't be down here. In fact, we could still end up away down here, potentially. It'd be very, very, very unusual if your board is slightly leaning to the right or slightly leaning to the left. But obviously what happens is you end up getting this big distribution here. And obviously what you can see is, if I now change this, let's assume that we reach up into a top edge now, and let's assume that it goes all of a sudden, and it goes very heavy sell side. Then of course what happens is that all of a sudden all those buy skews are now very badly trapped into this. And you can obviously see that there is now a very, very high probability that buyers just will not be in this distribution. And obviously what's going to happen is that all those trades are now filling into those low edge prices based on that skew narrative changing. You can see that every trade comes out of the pocket here as a buy trade, and there's an occasional sell that pops in. But you can see that even the sell's getting snaffled by the weight of the board to the left-hand side, right? So every time it starts to try and go right, every time any of these balls try to move to the right-hand side, there's a seller coming in and taking any of them. And this is trading, isn't it? Because if I'm sitting here, if I see any of these jumping to the right, here it is. I'm buying, I'm selling that, right? I'm selling this one here. So I'm seeing it jumping to the right. There it goes. I'm selling that one. I'm jumping to the right. I'm selling this one. It's jumping to the right. I'm selling that. It's jumping to the right. I'm selling it. In other words, you're selling upticks at that stage, aren't you? You're starting to sell upticks. Because as soon as you get one of those randoms running into the higher prices, when you've got a skew as good as this, you'll be selling upticks. But you're going to still have to wait for those upticks to show up. And it still doesn't mean the uptick is going to finish at the very bottom of this. You can see that the vast majority of them still end up into this area. So early on in this trade, I can almost pick up any sell that moves even one tick to the right. 2 ticks, 3 ticks to the right. It's almost a given. There's one I could have sold at 3 ticks to the right, and it finishes slightly better off, just. But when you start seeing it as a process, what we've got to try and do is we've got to try and establish this number here. We've got to try and establish that probability. Well, that's what Fisher transform does, is it establishes a probability. It starts putting us into the probability based on the cyclical analysis, that if we reach, for example, at -3 on the black line, so the HFT is effectively our sine wave, then of course we're down to about 2% probability that it'll go lower when we get into those, which is why the shakeout indicator gives us that incredibly high probability that it won't go any higher. But there's still a problem with that, Andy. An incredibly high probability that it won't go any higher or lower, based on what? Based on that being the correct Nash equilibrium, right? The best cycle. So we've still got problems. We've still got work to do getting that into that equation. Do you understand the point I'm making? So it's all right getting this probability frequency here, right? So the probability of this being in a sell trade is massively higher. But where does the sell come from? Where does the sell come from? And therefore, when we're looking at this idea of the probability, when we're looking at this from the idea of the spectrometer, we obviously have a very strong suggestion about the fact that we're probably at a high edge. We can make some easy cash, but that's assuming we've got it right. We need to know we've got effectively the frequency as accurate as we possibly can get the frequency. So when the frequency comes in and we've got the probability right, we can obviously make the big splash narrative. If we've got the frequency wrong, then of course the sell at those probabilities actually isn't going to be as good as you thought it was going to be, or the price is going to keep going in a direction that you just didn't think it was possible because you saw it on your Fisher and you thought that was it, but you haven't understood what Fisher is. Fisher still needs to be the correct frequency for it to be 100% as accurate as it possibly can be. And that's where the next step of this process is going ultimately to take us. Does that make sense, guys? So when we see it going glowing red and orange, so when you see it glowing orange here, you know, when it goes black here, then of course we're now moving into a possible problem. When it starts glowing orange, we are away from that problem. And we can get the sell onto that because the frequency on this is very close to the frequency on this. Do you see that? If the frequency is not very close, and this disappears and the frequency is not very close, this will not be as accurate. You understand that? So this one is not as accurate, is it? It's not as accurate. So we can recognize some of these as basic starting points for an analysis. If we can understand the basic starting points for an analysis, we can start getting a little bit more clever about where the trades are and how we're going to get the trade on, etc. And it just makes the overall analysis a lot more accurate to make sure that you guys are on the right frame of reference. And that's all we're trying to do with this little project. Well, that's what we've got, Andy. We've got a lot of tools that we can look at. So, for example, you can look at the autocorrelation. So when you look at the autocorrelation, that's telling us what that lag is, based basically on almost a Nash equilibrium type function. Because if we've got Nash equilibrium saying that the next candle should be down on a 30-minute chart basis, then that would be a period of 31-minute candles. So we're not going to suddenly fade into that if we've got a bottom edge forming. So by looking at the autocorrelation, or, you know, we can obviously start getting into discrete Fourier transforms themselves to help with this. It's not the same, but it functions in a similar way. We can start finding the correct idea for whether we should be short that narrative or not. Now, obviously, whether that's just gone over your head entirely or whether it kind of makes sense to some of you, this is the challenge we've got about presenting this as a classroom, because we're going to have a lot of people looking at the market and saying, I don't quite get this. So the basic idea is what we're trying to do ultimately is get so that the end game in this, Andy, is very straightforward. I'm trying to get to a point where we have the cosine of price on the right frequency. That's the end point, right? So in other words, we can predict with as high an accuracy level as possible on the correct time frame of analysis so that we don't have to change time frames to find the right trade. So if we can get the cosine, we know where the sine is going to come in, and the sine in this case is the price. So if we can predict the accuracy of the cosine idea coming in, we've got a great chance to then start looking at the probability that we've just found the right frequency and the right price. And if we can get to that point, we're in pretty good shape. So we're getting there. We're not a million miles away from it. It's just going to be a case of, this involves a big step up in the actual mathematics, which can obviously cause us to be, this is one of the problems we actually came across when we tried to do it. Kim will be able to tell you this, but when we did it ourselves, in fact, I think it was a conversation I was having with Greg as well about it. When we did it ourselves from scratch, we never took any prior coding. We basically coded it from scratch. TradingView couldn't handle it because TradingView has a thing called basically a timeout. So the program has to execute within between 20 and 40 seconds. And if the program doesn't execute within 20 to 40 seconds, it throws an error message onto TradingView, because obviously you're using TradingView's own resources, and TradingView's own resources are as limited as anybody else's ultimately. So when we did it, we couldn't get any indicator to run in TradingView because it always timed out. So we always got an error message, and we could never basically slice it down to the individual pieces small enough that it would make it run as a standalone. So we've had to go back to trying to find a shorter route version so that we can actually get this to work inside of the right time frame. So that's been a problem we've always had from the beginning even to the present moment. Obviously, these are the kind of things that we're not limited by our own computing, obviously.